Hey there, everyone interested in money matters. The financial world is a buzz. The stock market is making headlines. Right now, the Nifty index is reaching its highest point ever, and smaller company stocks are bouncing around a lot. In times like this, when stocks are hitting new records and things are unpredictable, it's important to talk about something that can help you, a concept called loss aversion. Loss aversion is a fancy way of saying that we really don't like losing money. Anybody likes to lose money? Exactly. So it can help us make smart choices with our money. Let's break it down. Nifty chart is at its highest point. The Nifty index is going up a lot and it's tempting to join in because it looks like a sure thing. Mid cap and small cap also in a highest all-time high and it's going up and down very quickly. But smaller company stocks are moving all over the place, making investors a bit nervous. Now you might wonder, why is this loss aversion thing is important? Well, it's important because we tend to worry more about losing money than we do about making money. And this worry can change the way we invest and trade. In this video, I'll be talking more about loss aversion and how it can affect your choices during this time of high markets and bumpy rides. I'll share some simple tips to help you plan your money moves wisely and deal with the market's twists and turns and make sure money stays safe while markets are flying high. So if you're ready to learn how to make the most of your money while keeping an eye on any possible losses, stay with us. We'll face the challenges and opportunities that market offers together using the wisdom of loss aversion. Let's dive in the market smart choices in this changing financial world. And this is Sundar and you are watching Mindful Finance. Stick around. Hey there, folks. Today we are diving into the intriguing world of decision making, the real brain teaser. Ever heard of the Asian disease problem? Well, it's not about geography, it's about understanding how our brain works when faced with choices. So let's roll into this. Picture this, there's a deadly disease outbreak, and you are in charge of saving lives. You have got two programs to choose from. The first one is called Program A. This one guarantees that you will save 200 lives. It's like locking in a sure win. The second one is a risky business. With Program B, there's a gamble involved. It's a bit like rolling the dice. Here is how it goes down. Let's see two outcomes. The first outcome of the Program B is that's a one-third chance that you'll save a whooping 600 lives. It's like hitting a jackpot, right? On the outcome 2, there's a two-third chance that you won't save any lives at all. That's right, absolutely nothing. With the simple term to explain loss aversion, it is about emotionally how you feel when you face losses. It may differ for different people. For example, if you gain 100 rupees, the amount of happiness you feel will be less than the same amount, like 100 rupees, if you lose. The pain of losing that 100 rupees is far more worse than the happiness you feel when you get 100 rupees. This is the overall concept of loss aversion. Here is the crazy part. When people are faced with Program A, which guarantees 200 lives saved, many of us go, sounds good to me, as it's a safe and no nonsense choice. But when Program B enters the scene, things get interesting. Although Program B has a higher expected value, which is one third, which is 200 lives on average, many folks hesitates. Why? Because it involves a risk, and that risk is two-third chance of not saving any lives at all. Loss aversion suggests that people tend to be more averse to potential losses than they are motivated by equivalent gains. As a result, option A is often preferred when individuals prioritize avoiding the possibility of loss over the potential for a larger gain. Option B may be less appealing to individuals due to the fear of losing out, even though on average it offers greater potential gains. The key takeaway is that loss aversion is a psychological bias that impacts how people make decisions. Whether option A or option B is good depends on individual circumstances, risk tolerance, and goals. Option A is favored for those who prioritize safety and certainty. It's good choice for risk-averse individuals who want to avoid the emotional distress associated with potential losses. Those are willing to take calculated risk and who are comfortable with the possibility of losses for the potential for higher gains may prefer option B. However, it's essential to consider risk and reward carefully. Ultimately, there is no one size fits all answers. Decisions should be based on individual preferences, objectives, and the specific context in which choice is made. Loss aversion serves as a reminder of how our emotions can sway over our decisions, but it's up to each person to determine what is good based on their unique circumstances. To explain this, let me tell a small story. In Mahabharata, it involves a critical moment in the great Kurukshetra war where Duryodhana, the eldest Kaurava prince, and the Yudhisthra, the eldest Pandava prince, approach Lord Krishna for help. But each one receives a different kind of assistance. Duryodhana, who was known for his greed and ambition, arrived at Lord Krishna's dwelling first. He saw Krishna asleep and positioned himself at Krishna's head. Yudhisthra, who had a strong sense of righteousness and dharma, arrived later and chose to sit at Krishna's feet, humbly waiting for Krishna to awaken. When Krishna opened his eyes, he saw Yudhisthra first and greeted him with warmth and love. He asked Yudhisthra how he could be of service. Yudhisthra, always the embodiment of Dharma, replied that he only sought Krishna's blessings and guidance, not his army or any material aid. Meanwhile, Duryodhana, eagerly to bolster his army, asked to Krishna's mighty army, the Yadavas, to join him in battle. Krishna, who had already decided to personally support the Pandavas in a non-combatant role, agreed to Duryodhana's request but added a condition. He would not personally fight in the war but would be present as an advisor to one side and his army would fight for the other. So Duryodhana, driven by his desire for victory at any cost, believed he had outsmarted Yudhisthra and considered Krishna's army to be a great triumph. However, Yudhisthra, wise and principled, considered his audience with Krishna as the true victory. He knew that having Krishna's wisdom and guidance on their side was more valuable than any army. Here's how this story illustrates about loss aversion. How to map this with loss aversion? Let me explain it. Duryodhana's primary motivation was to win the war and he sought immediate material gain. His attachment to victory blinded him to potential wisdom and guidance that Krishna could have offered. Yudhisthira, on the other hand, valued Krishna's wisdom and righteousness over material wealth or military strength. He was not averse to the potential loss of a powerful army because he understood that having the right principles and guidance were more valuable in the long run. So Krishna's decision to be present for one side and provide his army to the other highlights the importance of balance. It shows that material possessions like an army are not inherently good or bad. It's how they are used and the guidance behind their use that matters. In essence, this story from Mahabharata teaches us that focusing solely on material gains can lead to short-sighted decisions and a fear of loss that blinds us to higher principles and wisdom. Yudhishthira's choice to prioritize Krishna's guidance over an army exemplifies the concept of loss aversion, and the fear of losing something material can overshadow the importance of deeper values and principles. So using this, let's discuss about a simple example. Now let's draw a parallel from the world of personal finance. Just like in our dilemma, when it comes to securing your family's financial future, you face choices. For example, term insurance is like Program A. It provides a guaranteed payout in case of an unfortunate event, ensuring your loved ones are financially secured. On the other hand, there is a guaranteed return plans which may seem like Program B. They promise both insurance coverage and guaranteed returns on your investment. But remember, just as with Program B, these plans often come with risk and may not always be the safer bet. So why do we bring this up? Because understanding loss aversion sets light on how we make choices from everyday decisions to complex ones. Sometimes we let our emotions get the best of us and choose the safer options even if it means settling for less. And that, my friends, is the Asian disease dilemma, a little brain teaser that shows just how fascinating decision making can be. Imagine you are at a crossroads considering two different stock investment scenarios. In our first scenario, you take on the persona of a risk-averse investor, a person who values stability and is averse to losses. Averse means fear. So fear to losses. You have the opportunity to invest in a well-established Indian company. Let's call it ABC Limited. This company has a history of slow but steady growth. Your projection for the next year is a conservatively like 5% increase in stock value. Now in our second scenario, you become a more risk-tolerant investor, a person willing to take chances for potentially higher returns. You stumble upon a promising Indian startup, say XYZ Inc., operating in a high-growth sector. You believe there's a 50% chance its stock could double in value over the next year. but there is also a 50% chance it could lose half of its values. So here is where loss aversion comes into play. As a risk averse investor, you opt to invest in ABC Limited. It offers stability and it is a conservative 5% growth projection. Why? Because you prioritize avoiding the possibility of significant losses over the allure of higher potential gains. We can take an example of fixed deposit also. However, in our risk taking scenario, even though XYZ in could potentially double your investment, you hesitate. Why? The fear of losing half of your investment carries substantial emotional weight. The impact of loss aversion is clear in scenario 1. The fear of losses leads you to choose a safer, though potentially lower returning investment. In scenario 2, the fear of significant losses outweighs the allure of potential gains influencing your decision. Remember, loss aversion emphasizes our psychological tendency to prefer avoiding losses over seeking equivalent gains. It doesn't make one approach better than other. It all depends on your own risk tolerance, investment goals, and emotional response to potential losses. So, when investing in the vibrant Indian stock market or any financial assets, it's crucial to understand your risk tolerance and financial objectives. Loss aversion is a reminder of the emotional aspect of decision making and its potential impact on investment choices. To demonstrate this one, how your mind works and what kind of a decision you have to select, whether the plan A or plan B. So let me demonstrate a simple one. Using this, you can understand which one to choose, because program A or program B of both are based on your emotions, and there is nothing right or wrong in this one. It's fully about how your mind is prepared for this situation. So let me demonstrate this one for you. Let's take an example of Nifty. So you see, this is what it says. If I do a technical analysis, so if you see the Nifty chart over here, it has already made a higher highs and it is an uptrend, and this is a daily chart and it has given a very good run here. Now you see a red candle over here, a bearish candle over here. Now what you feel? What will be your decision? Whether you'll go with program A or program B? Whether you want to do a safer bet or you want to take a risk, or are you scared of entering the market, or are you scared of staying in the market? What is your mindset would be here? So that is the concept of loss aversion. There are people may try to book a profit or try to sell the stocks over here, or they may feel that if I sell this, the loss which I am going to occur may be more. Even though they have traveled this much of journey, they have made so much of profit, but they may get scared of a small loss which can happen here. I don't know like whether it's small loss or big loss, but this is the scenario, this is the place they have to be careful. One thing is, you need to have a stop loss. You need to be clearly planned about what you are doing. If you want to book a profit, or if you want to plan something else, or if so, this is the place where people get stumbled, which means what to do next. There are two options, right? So this has already given a very good run here. They have made a good profit, but this profit is still, they may feel as a, they may not, the happiness the people may feel maybe less compared to even if the market corrects something and it comes to 5% or 2% from the high. The loss which may occur during this point of time may be more emotionally affect the investors. This will shake the investors. They may try to sell the stock immediately after they find the small amount of loss over here. Or there are a risk taker, they may feel like to wait some time, or they may stay invested. So it's all depends upon your mindset. For example, if I show you let me show you what happens after this. So what is the decision you would have made? Just keep it in your mind and let's see what happens now. So now what happens? Just think about your mindset by looking at the candles. So this is higher low, so it's okay. But when it cross this, this is where the shakeout happens. People will start to panic over here. What happened now? How is your mindset till it reaches here, right? So it almost came closer to your the previous this area, right? When it travels this much of loss, everybody will get panicked. Whether to stay put in this market or to run away from the market, book the profit and exit from the market. All those kind of emotional triggers happens. But if you see next, what happened? It has made a huge comeback. It has gone far away, right? Now again, this is the current status. Now what happens? So this is what happens always in the market. It shakes your mind. It's very difficult for retailers to stay put in the market unless until you are convinced about what you are doing. If you are strong about your convictions, you can take risk and you can get more rewards. Now, as we conclude, let's distill some key takeaways that can guide you on your financial path. Loss aversion at its core reminds us that our minds have a unique way of perceiving risk and reward. We often fear potential losses more than we desire equivalent gain. But here's the catch. Understanding loss aversion doesn't mean you should avoid all risk or cling to safety at all times. It's about finding the right balance. In the world of stock investment, it's vital to recognize your risk tolerance and investment goals. Some may prefer steady, low risk options, while others may be comfortable with a bit of volatility for the potential of higher returns. Remember, what's right for one person might not be the best choice for another. Your financial journey is unique. It is designed for you. It is for your goal, for your future plan. To make loss aversion work for you, consider these strategies. Diversify your investments to spread risk. Set clear financial goals. Stay informed and make informed decisions. Keep emotions in check. Don't let fear drive your choices. By planning wisely and staying informed, you can make confident financial decisions that align with your objectives. While loss aversion can steer us away from potential losses, it's also essential to recognize opportunities. Sometimes calculated risk and mindful finance can lead to significant rewards. As you navigate the intricate landscape of stock investment and personal finance, embrace the wisdom of loss aversion. Let it be guiding light that helps you protect your wealth while seizing opportunities when they rise. Thank you for joining me on this journey through the world of loss aversion. I hope you have gained valuable insights to make informed financial decisions and build a secure future. Remember, your financial journey is an ongoing adventure. Stay curious, stay informed, and most importantly, stay in control of your financial destiny. With loss aversion as your ally, you can navigate the complexities of the financial world with confidence. Stay informed, stay empowered, and may your financial journey be a mindful and fulfilling one. Thank you. If you like this video, please subscribe, press like button, press the notification button, and please do share this to your friends and colleagues. Thank you.